Okay. So, hi everyone. Welcome to another episode of our webinar. So, I'm the CEO of Dr. Capital. I'm Dr. Fasanya. In this webinar, we focus on helping fellow physicians achieve financial freedom through strategic investment in real assets. Our mission, both Time Health Capital with Dr. George Ozoude, my co-host, and Dr. Capital, is to empower high-income earners like us, especially those in the medical community, to build generational wealth and attain financial freedom and security. Through educational initiatives like this webinar, I aim to share the insights and strategies that have transformed my financial journey, and then you can do the same for yourself. So we have guests here and there. Sometimes it's just us, and sometimes we have guests. And this time, we have Keshav. And so Keshav is the principal and founder of Clive Capital, which is a private equity firm that help investors move beyond the stock market into alternative assets such as real estate, energy, small businesses, and more. And these assets help investors passively build generational wealth quicker through superior risk returns, cash flows, and tax benefits. So they've assisted investors in investing into renovating 1,000 plus apartments and building 500 plus single family homes across 3 different markets in the US. He also has a podcast on Spotify, which is Investing for Generational Wealth. And they're currently doing a build-to-rent community in Lafayette, LA. So I'm going to, first of all, give it to George to introduce himself, and then we're going to throw the mic to Keshav. And we're going to make it more of a question and answer. And listeners, if you have any questions, feel free to type it in the comment section. And because there's not a lot of us too, you can raise up your hand and you can actually just ask and come off mute. Okay, go ahead, George.
Hey, thanks, Bio. So George Ozoude here. I'm an orthopedic surgeon based out of Houston, Texas. I've been investing in real assets since 2016. And Bio said our goal is to help as many physicians as possible, help as many high income earners as possible. I started my journey investing, and I've seen the benefits of it over this time frame. Started investing as an LP into multifamily value-add acquisitions and development, have branched out into agriculture, mineral rights, and medical office buildings. And so a real big believer in passive income strategies that will allow us to regain our autonomy and our financial freedom. So I've gone on to open Time Health Capital. It's a syndication investing firm focused on financial freedom for physicians. It's been 3 years, and we've invested in over 4 properties, over 800 units, accounting to about 75 million in assets under management. And this is mostly multifamily. We look to diversify and branch out, and I think we're going to talk about a lot of those concepts on this webinar. So I'm really excited to have Keshav on and learn from him and his experience.
Okay. Yeah, thanks, George. Keshav, if you don't mind, at least briefly introduce yourself and tell us what's your background.
Sure thing. I just want to start off Bio, and George, thanks for having me here. It's a pleasure to be here and hopefully share some value with your audience. My background, I'm a software engineer, used to work at Amazon, and now I'm at Meta. I graduated college 5 years ago, and out of college, I was at a car company, also coding. And I think many of us in the space, I read Rich Dad Poor Dad, and that's what got me interested in real estate. I had a 15-hour flight to Southeast Asia post-graduation trip, and I thought, what better way to spend it than to read Rich Dad Poor Dad? Not that it took all 15 hours to read the book, but that got me interested in real estate. I became a realtor and started selling homes, residential homes in Detroit at the time, back in 2020. Luckily, before I went down the residential route, one of my friends, he came across a Reddit post where someone was talking about syndications, about buying apartment buildings, doing these bigger deals, and how you can be a passive investor. and get all of these benefits, right? The tax benefits, the superior returns, all passively. And to me, no one I knew, my friends, family, coworkers, no one had invested into these syndications besides my friend's dad. And so I took the next year from fall of 2020 to fall of 2021 to learn about these investments and how they worked. Once I felt comfortable enough that I could make the investment, I made my first LP investment into 108 apartments in San Antonio. I started seeing the cash flow come in, and I got my K-1 tax form. And that was a proof of concept to me that, hey, this works. And if I'm going to do this for myself, build generational wealth and attain financial freedom like you guys were talking about, then I might as well do that for my family and friends, anyone else who's interested in coming along for the ride. Because what fun is it sitting alone on the beach all by yourself? So I started my company, Clive Capital, in January 2022, and our goal is to help investors, everyday investors really, build generational wealth primarily through, I would say, yeah, like the asset classes that you guys mentioned, as real estate, energy, small businesses, and private lending. And really what we try to balance in our portfolio is appreciation, cash flow, tax benefits, liquidity, and risk. And so the goal is to just build out a portfolio that balances those out based on what the investor is looking for, so that one investment or another is paying them every month, every quarter, regardless of what they're doing, where they're living right now, whether they're hanging out with friends or working, to achieve that financial freedom like we're all chasing.
So I notice it's things that we're also interested in, the real assets, tangible things you can touch and feel, as opposed to the stock market, paper assets. What is it that you cite as a big difference? What don't you like about paper assets versus real assets that your company focuses on?
Yeah. Some of the big things that I don't like about typical stock market investing is just one, for me, the 8 to 10% that you usually see on average in the stock market, that just isn't enough for me. I'm always looking for, can I do better? And not only can I do better, but can I do better on a risk-adjusted basis? I don't want to go out there and just day trade, because I'm sure the rewards are there, but the risk is also there. So I want higher reward without having to take an outsized amount of additional risk. That's where the concept of risk-adjusted returns comes in. And I would say tax benefits. You have your short-term capital gains, long-term capital gains, and qualified dividends, things like that. But again, nothing's as, not a CPA, but real estate has its tax benefits that we get, depreciation losses. Businesses in general, if you own the business, you get to take advantage of the expenses that get passed through to you as an owner in that business. And then energy I like a lot, because the depreciation losses can offset even active income, W-2 income. And so I myself invested into oil and gas syndication in November and reduced my software engineering salary that way. Again, not a CPA. And so I feel like those are some of the things that you cannot get in the stock market. And I would say beyond that, cash flow, right? Your dividends in the stock market are maybe 4%, 5%. We want to do better than that. Transparency is another big thing. The top tech companies out there, even as a software engineer myself at Meta, I couldn't tell you how Meta makes its money. I could, at a high level, tell you there's ads and there's the VR headsets that we make, but I couldn't tell you like, hey, here's the profit and loss, and here's how we could bump that up. But in real estate, for example, it's really easy to say, hey, here are the rents that are coming in, here are our expenses, here's our loan service, here's how much our bottom line profit is. It's a lot easier to understand these tangible assets that you're a lot closer to, also because you're not just investing in a $1 trillion company. On the stock market, you're investing into a smaller syndication. If an investor has a question, they can reach out to me, or they can reach out to Bio or to you, George, to figure out what's going on with their investment. I can't call up Zuckerberg and say, hey, why are Meta shares down 10% today? So there's that lack of transparency or availability to information in the stock market. And then I would say,
agree.
Go ahead.
Yeah, get some more. Yeah.
Oh, I was going to say, I have a long list of these, but the last one I would say, my qualm against the stock market is the lack of diversification. Generally, the market moves together in a direction, right? If a war breaks out somewhere, a pandemic happens, the entire market is down. Even if it doesn't affect, in real estate, for example, a war happening in another country doesn't really affect how much our apartment buildings are worth, directly at least. So I would say just diversifying, where if one thing happens, your entire portfolio doesn't tank. I think that's another big benefit of getting outside the stock market.
Yeah, I love those reasons. I resonate with many of them, and I always like to add on. I think the list can go on, and not completely bashing these type of investments. I think they do serve a purpose. They're very conservative, or can be conservative. Obviously, there's so many people who invest in 401ks and retirement accounts through their jobs. And yes, over the last 40 years, we've just seen a pretty steady bull market and a predictable return from these type of investments. But I also do add, it's tough to invest in individual stocks. It's volatile. It can be very volatile. Like you said, it can go green or red, depending on what's happening in current events. I always never quite felt comfortable investing into a stock whose CEO can end up on a headline the night before, and then the next day, for whatever reason, that stock is now tanking while I'm in the OR operating. And it's this volatility that is not in real assets. It's just slower moving. You can see a problem coming and you can adjust. I love that about real assets, in addition to the great list you put out there.
Yeah, I echo that too. I heard you said something about oil and gas, right? So we've been investing in oil and gas also. Our result has been very mixed, which is going to tie into some other questions about we talk about the negatives of stocks, and just talk about some of the risks that you also see in the alternative assets also. So first, oil and gas for us, it's been mixed. The tax advantage was great, okay? Don't get me wrong, we got 90% depreciation first year from the intangible drilling cost and also the depreciation. So for tax purpose, absolutely. First few years, we got like 20% return, very great. And then the price of oil went down, and now the return is lower. So it's also volatile in a way, almost like the stock market. Just wanted to see what are your own experience. You said November, so it's not been a while. We've been in for 3 years on my end. That's one. And also, so just talk about those risks. I also would like to know what's your own percentage in terms of your portfolio. So I'm taking your portfolio as 100%. Like, how many percent is stocks? How many percent is real estate? And how do you break that, even the real estate, down? 20% of multifamily, 10%. Basically, what is a perfect portfolio look like to you? So let's talk about the risk first, and then what's a perfect portfolio?
Yeah. All the reasons I bashed on the stock market, there's definitely risks in investing outside the stock market too. No investment comes without its risk. I would say the number one risk, regardless of asset class, whatever you're investing into, is who you're investing with. If you invest with the wrong person, then they could take a great deal and really screw up the returns on an otherwise great investment opportunity. In the worst case, they could be fraudulent. They could run off with the money. So you want to make sure that you're working with the right people who have a great track record, who have references that you can talk to, who have a common goal in investing, or like something you can relate to, where you can see some commonalities between you and this person, as far as, hey, is this person someone I would like to work with long term? Because it is a business relationship, and a lot of these private equity opportunities are long term. Your money's in there for 3 years, 5 years, 10 years. Beyond that, each asset class comes with its own risk. And oil and gas, for example, it is an asset class that I'm still newer to. But I know that, one, I feel like the space isn't as mature as real estate, and the risk for fraud or incompetence is a lot higher. I think people understand oil and gas a lot less than they do real estate, and the space just isn't as like I said, mature as real estate is. Maybe one day it'll get there, but right now, I first heard about oil and gas investing February of 2022, but I just didn't feel comfortable with who I heard it from or what anyone else had to say about them. So I waited a good year and a half to actually find a group that I felt confident working with and hopefully soon raising capital for too. And then that's oil and gas specific, but then each asset class obviously comes with its own risks. Like I was saying, like in oil and gas, you don't know that you're going to hit oil and gas that you can actually extract, right? Your geologist could tell you, to my understanding, that there's oil and gas beneath the earth. But if your drills can't get down there for rock formation or whatever other reason that geologists could better explain, you're not going to extract the oil and gas, even though it's there and you detected it. And so that possibility, or the possibility that there's not much oil and gas at all, like a dry hole, those are all possibilities. And I think and then another one in real estate, for example, right now we're seeing a lot of distress, fair amount of distress in multifamily with people who had floating rates on their properties back in like 2021, 2022. They've either paused distributions or been foreclosed on. So I think the key there is really to diversify asset classes. Make sure you still understand what you're investing into, but diversify asset classes, diversify the operator, the team that you're investing with, diversify the geography that you're investing in, different states, different markets. So those are some ways to mitigate risk when you're looking at these alternative investments. Okay. And then the second question, let me see. As a passive investor, so I have equity in these opportunities because I raise capital, and as a fund manager, and then other opportunities on our single family home construction, I'm a partner there. So I'm not going to count that in these because I don't even know what to value. It would be interesting to value those equity stakes. But as a limited partner, I would say my portfolio right now is probably, I don't know, a third in the stock market, just through my 401k only, just because the employer match. And let's see, beyond that, a third in the stock market, then maybe a fifth in real estate. Let me make sure I'm doing my math here.
You don't have to be exact.
I know.
Yeah. Okay. I would say it's like a good chunk of it's in the stock market. A good chunk of it is in oil and gas, and also real estate, split pretty equally. It's probably 2/5 in the stock market, 2/5 in oil and gas and real estate. And then the last fifth, I'm building a life insurance policy. And so I'm accumulating cash value in there as well.
You kept it very simple, huh?
Yeah.
What about business acquisition?
So we're looking at businesses right now that we can acquire. It's still a new area for us to understand how, like we hear about, I think it's called the silver tsunami, all the baby boomers who are retiring, the businesses that are coming up to be bought. I have partners who are buying up construction companies and manufacturing companies, etc. And I know that's something I'm interested in long term. It's just a matter of getting my foot in the door there. Hopefully soon here within the next year, that will become a part of our portfolio as well.
Awesome. Yeah, because we do acquire businesses too. Of course, I have private practice also. And then, so across multiple sectors too, many in healthcare and also real estate. So that we figured, those 2 hours going to be there. So like construction company is a good idea.
Yeah, I agree. I haven't bought a business yet, but I'm very interested in it. Cash flowing businesses where you can really structure things to take over and run it efficiently or improve the efficiency. So it's an exciting time to start looking at those. I'm pretty shocked and just pleasantly surprised how accessible some of these businesses are too. You look at some of the listings for different websites where you can find these deals, and for all the cash flow that they make, some of these businesses you can acquire for, hundreds of thousands of dollars, and it's not $1 million deals. Some of them are, obviously, but a good amount of them are very accessible. So there's maybe a lower barrier to entry, depending on kind of your financial situation. And for physicians, that could be very promising. You have a practicing doc who's 5, 10, 15 years in, they probably have accumulated enough of a little bit of a wealth chest to go out and buy some of these businesses. So it's an exciting time with the silver tsunami, like you mentioned. I was curious about the debt fund side. I think it's not as known as like the equity side. And I was wondering if you could talk about that, your experience with it, pros and cons, why you like it, and just shed some more light on your experience with it.
Yeah, there are a few debt funds out there that we're looking at that are issuing 15+% per year. And I would say their credit is having a good moment right now. Has been, I would say, for the last year, where a lot of people, they're scared on the equity side of things. And a lot of people need borrowing capital to keep a lot of these projects afloat. And so I think if you structure the terms correctly, where you have your collateral, you make sure that, one, you're lending to the right person so that you don't have to go after their collateral. Two, if you do have to, that the agreement's structured properly and everything. I think debt funds have a good place in a portfolio from the cash flow perspective, right? If you can hit 15 to 20% per year in cash flow, that's a great opportunity in my eyes. And combine that with using a tax advantage vehicle like a retirement account, right? If you make your investments into a debt fund out of your retirement account instead of only growing 8% per year is now growing whatever, 15, 20% per year. And all of that is going tax deferred or tax free, depending on the type of retirement account that you're in. But I think debt is just, right now, at least with where interest rates are, that's another great asset class that I like for that reason. Now, with rate cuts on the horizon, depending on how deep they decide to go, it might not be a great idea. But again, these things come in cycles, right? Real estate had its moment in 2020 when everyone was flipping properties and multiple offers. And then now real estate is suffering, but then debt is doing well.
Yeah.
For your debt, we've seen a bunch of them. Almost everybody is doing some form of preferred equity or some form of debt recently. A strategy that I've seen them using is usually they'll be like, okay, we give you 7% now, and we carry the 8% to the end of the deal. I mean, I prefer, if I'm that, I just want to get my 15%.
Yeah.
I don't want to be, if I want to be equity partner, I'm just going to be equity partner. But if I'm dead, because then you run that risk also of if the deal doesn't do well, then you basically lose that 8%. So what are you seeing? What structure are you seeing?
We're looking at like a mezzanine debt fund that's doing pretty well right now, where you're not delaying any portion of that. You're getting upper teens every year. This debt fund has only been operational for a few years. So, I mean, there's that, but it's been doing well so far. And I think there are a few others out there like that, maybe even in first position, but yeah, no. If it's the debt fund, ideally, I would like to I don't want promises.
I know, right?
I don't want promises. I just want, if it's debt, I want it now. I want to keep my promises for my equity investments.
Yeah. Yeah, I think with first lien, they're probably de-risk because they're first in line on the stack. So they're probably returning something lower than the double digits. Maybe they're getting up into the 10%, but probably living around 8, 7 or 8%. So it's probably easier for them to deliver on a monthly basis that amount. But once you get up into teens, like you're saying, yeah, I've been seeing a lot of those accrued versus pay at the end after 3 years. And I do think that's harder to swallow. That's a harder pill to swallow.
It is, yeah.
Good. So anybody, if you have any question, let me see the chat. If you have any. Okay, somebody asked a question. What kind of category of small business have you helped acquire? I'm interested, but I've not seen a reasonable business to acquire. So I can answer that too, because we did acquire some. I do wish I brought my Richard, who is our business analyst. So far, we got an electrical company, sign company. Richard does have an awning company. We have a DME company, durable medical equipment company. I have a car audio company which is mostly cash, very great business. I think I've made most of the list now. So yeah, so we are mostly looking into more of the real estate related. The electrical company was basically because one of my projects got delayed almost 6 months because of electrician. And basically it's one of those things that I've said, we're gonna control this. So no more looking for electrician. So we have full control. So that's one of the things that pushes. And then for the medical equipment company, I'm a pulmonologist. In these outskirts, smaller towns, the bigger medical equipment company doesn't want to take the equipment to them. And there are people with no oxygen I'm telling you, like for months, because they can't deliver it. And it's not something you can really live without. So it was started off as more of be like, okay, this is a need. But of course, they find a way to make money from it too. So that's usually what it is. There's always a need for something, or it's just a personal vendetta of sign. Every single property we buy or self-storage, the first thing we do is to change the sign. Unless it's like really good, but almost always, there's always a need to do that. So then Richard is, man, I need a sign company. And then now I have some partners working on a title company and insurance company too. So those are how we think about it. Keshav,
I'm going to ask Keshav after I just add these two, because I haven't had any business acquisitions, but from what I've been coming across, blue collar businesses are hard for AI to disrupt, at least right now. It's more the white collar. So plumbers, electricians, like Bayo said, auto repair, and then businesses that require subscription-based, pest control or tanning salon or dog daycare, things that require just this recurrent model of subscription-based business. I'll kick it to Keshav.
Yeah, I unfortunately don't have much experience here, but I know one of my business partners, like I mentioned, they're the ones going out there buying. I think they have a cylindrical gas company, like those cylindrical gas tanks. They have trucking companies. Someone I know is buying a paving company. So I like anything that has a physical, like a hard, tangible asset, right? So I like anything that has a tangible aspect to it. That's a recurring need, right? I thought paving company, why would you need a paving company if once you've paved the roads? But then I walk around here in New York all the time, and there's always something or another, some repairs happening to the road, and it's always getting torn up and then paved over again. So I think something that's tangible, recession resistant, you're going to need it regardless of kind of what happens out there. I don't know that I'm going to buy a restaurant unless it's a hobby project, for example.
The restaurant is literally probably I remember it being like the number 100 of like literally the business you want to buy. Like
Exactly.
very, very low on the list.
But I like what you said, George, about like blue collar workers. I was talking about this with my coworkers too. And one of my coworkers said that a partner at a legal firm, a lot of the AI is taking over a lot of the like entry level associates, whatever they call them in the legal world, entry level lawyers.
Paralegals.
Paralegal, because it's just scanning documents. A lot of them are up on the internet. You can scrape them pretty easily. ChatGPT can come up with templates. But like you said, blue collar work, physical work is a lot more difficult to replace with AI. The robotics, I'm sure Boston Dynamics will get there one day, but it's just a lot further behind from a lot of the more intellectual work that like white collar people typically do.
I think, I just was talking to a bunch of friends that want to acquire also. Basically, they said, look for burning business. Basically, you don't need to be too exciting in your acquisition. Just like you said, basic everyday things. Like I have a friend that did a lawn mowing company. And I was like, man, what's different between another Spanish guy starting another lawn company? But he ended up getting contract with corporations instead. So that's huge. You only need 5, and these are recurrent. They're like cutting checks of $20,000. Be like, okay, we don't want to hear any story, just mow everything all year long. So he used a different technique. It was combining residential with commercial. So it's like whoever's going to pay will mow the lawn. So I think it's doing so well. Yeah, and it doesn't have to work in it, right? You hire other people doing it.
Yeah, a lot of times you can structure it where you keep the current owner on and have them phase out, but still help with the transition. That helps them out because they can still be part of the business that they were passionate about, maybe not deal with the administration and operations, but just work on the actual business itself. They can be included through some kind of seller financing where they're actually getting a little income, some passive or active income from it, and making money off like interest on a loan that they give for that transition. So there's creative ways to keep them involved. So, because that might be a barrier, right? Or we know medicine, or we know whatever where our lane is, our ministry, but do I know HVAC companies? Maybe I don't have to. I just have to bring in the expert who does, or keep him on for 3 to 5 years and let him help with the transition until we find some replacement.
Yeah, that's usually what we do. We usually keep the person in as high as equity. Like there is one, we give 35% equity to the former owner. So
85.
Yeah, it doesn't have to actually pay them. We basically absorb it. Basically, we're bringing in the business expertise and marketing and other part of it into the business. We become a majority owner. And obviously, you always find a business that has a waiting list. That the car audio company does have. The guy was doing it all by himself. I was making like $35,000. But the guy is hardworking. He does good products, but he has like about 6 month waiting list. It does like people pimp up their rides and things like that. So what we end up doing is basically just absorb him into it. Be like, okay, you can't be this person that goes to the front desk, talk to people in like dirty clothes, and then shake their hands and then walk them to the back and then fix their car and then go market. Basically, you need to hire someone. So anyways, he doesn't know how to do it. He doesn't want to do it. So we came in, I injected some capital, obviously, also into the deal and to hire the right people. And then now he's able to make more than what he was making before, right? Now he's making, close to $60,000. So based on his percentage ownership. So that's things to figure out, things that can scale. It already have a waiting list. Anyway, so that's just one of the ways. Or you can just keep them as a salary, just like a private practice too. When you buy a private practice, you always keep the doctor on, right? Because they know if you eliminate that person, oftentimes the business is linked to that person, so that when you eliminate them, the business is dead in some businesses because they know them, they know the area, the name, the brand is that person in some way. So you keep them and they start getting to know the other doctor for a while, and then slowly transition people over until that person become like an advisor. It almost never leaves. You still keep them as an advisor, a small nominal fee to continuously give you their experience. There's another question here. Where are you finding these businesses for sale? Are you acquiring them mostly SBA or seller financing? So I can start with this too. I know I enjoy the business part, but we're going to answer just this one, and then we switch back to your project, Keshav. Well, am I finding it? Most of the deals, once people know that it's just like real estate. Once people know that you buy businesses, they come to you now. So many times, because I live in a smaller town, 120,000 people. So we're quite popular, and people just tell people. Keep telling anywhere you go, any time you talk to people, we're buying businesses. Okay, tell them. And usually people come talk to you. There is also some companies that does business acquisition. We do have relationship with some of those, almost like a commercial broker, but these are business brokers. And you can talk to them and they'll you tell them what your criteria is, what you're looking for, they will bring it to you. And they actually help you do the underwriting and analysis also. Of course, you have to look at it for yourself. also. But I think you still need someone that at least understands businesses, have scaled some few businesses before in the past on your team. And then SBA or seller financing. Yeah, either seller financing, incorporating the person into the company, or we pay with our own money. I never personally did SBA. We raised for the electrical company, we needed $1.3 million, and we just emailed our investors. And then about 4 people showed up and came up with the money. But of course, you have to give a percentage ownership. I'm okay with giving percentage ownership overall, as long as a smaller piece of a bigger pie and long term, you have a lot of pieces of this, of that, and you have 100 of them, you make far more than keeping just one, and also more diversified that way. Okay. Do anybody has anything to add before I ask the next question for Keshav? Okay. Yeah. One of the few things I wanted to ask is, what do you have going on right now? I know that you're trying to do some build to rent, which we've had someone come by and talk to us about that before, but we'd just like to hear from you what you're doing, why that now? What do you think in the next 3 to 5 years is going to be happening, and what should we be looking at now as a syndicator and as an investor in the next 3 to 5 years?
Yeah. So we have about 500 homes under development right now, and in kind of various stages. And we usually buy land 10 acres or more, all the way up to 50, and we'll build 8 to 10 homes per acre, including amenities. So we'll put in playgrounds, clubhouses, pools, ponds, walking trails, all that good stuff. And we like build to rent because we know that as a nation, supply is not meeting demand, right? Depending on where you read, we're anywhere between 2 to 4 million homes short of where we need to be to meet demand. And we've seen that in home prices not coming down significantly nationwide, I would say. Each market is different, but nationwide, even though interest rates have gone up a lot, housing prices haven't significantly corrected as a lot of people thought they would. So the demand is there. And I think this year, I was reading today that we have 600,000 completions coming online or something, like a new record of completions since the 1970s, 1980s, maybe. So in the near term, rent growth will likely be pretty flat. In some markets, maybe even negative. But then again, all the supply is hitting from 2020, 2021, when rates were really low. Now that rates have been really high for the last year, historically speaking, the last year, we're gonna hit another shortage in a few years. This is gonna come back to bite us because the cost of capital is so high, people aren't building as much anymore. And so even right now, though, the delta between owning a home and renting is $800 per month, something like that. And unfortunately, with just where most people are in our country today, I think a lot of us here, software engineer, myself, physicians, were lucky and not lucky, but I don't know what the right word is. It's escaping me. Grateful. It's good to be in this situation that we're in, basically. But that's not the case for a lot of your everyday American. They can't afford to make that extra $800 payment. So they're obviously going to go for the rental when housing prices are as high as they are and interest rates are as high as they are. And now, if they're going for a rental, would you rather live in an apartment where you have neighbors on all sides of you, left and right, up and down? Or would you rather live in a single family home where you have a backyard, you have your own fence, your driveway, and you get the benefits of living in an apartment? You don't have to take care of your backyard. You don't, if anything breaks, it's on the landlord, as it is in an apartment. And it gives you that mobility. If you don't know if you want to settle down in like Dallas, for example, you can live in one of these built-to-rent homes or condos and then just move out later, but still experience home living, home ownership, just and I guess not ownership, home living as a rental. And so we've noticed that a lot of people who rent from us, there's statistics out there, I forget what the exact numbers are, but people stay longer in built-to-rent communities than they do in apartment buildings. And like your tenant turnover is lower. And we also attract a lot of elderly people because there's not as many stairs to climb, or floors, I guess. It's more easily accessible. And all this construction is new, right? So you can put in the latest prop tech and make the living a lot easier for the elderly. And then your millennials, your Gen Zs, they love the prop tech that you're putting into, like smart home stuff. A lot of them will have pets. So we put doggy doors on all of ours. We have playgrounds for dogs, pet washing stations. I think overall, from like a lifestyle perspective, like a funny personal story is when I was growing up, we lived in apartments and I was a noisy kid and I would jump up and down a lot and scream. And my parents got complaints from our neighbors. Now, when you live in a built-to-rent home, you're not going to get that because it's just your home. There's no one on either side of you or above or below you. And then we've noticed also that's like why residents would want to live there. Institutions, there's a Warren Buffett quote out there that I think he said in a 2012 interview with CNBC that if he could buy a couple 100,000 single family homes and manage them, he would. But so far, your only way to accumulate that portfolio is to buy scattered sites of homes. That's not as efficient for property management. But if you have a single rental portfolio of single family homes, that's a lot easier to manage. When we look at exiting, we know that these institutional investors, pension funds, they want to have this in their portfolio. We have a nice exit plan there. And then lastly, I would say from the city's perspective, in Lafayette, at least where we're building right now, but even I've heard in other cities, the city council, city planners, they just like this concept a lot more. It's a lot more appealing to them when you have rows of single family homes and amenities that bring the community together, like I was mentioning, like a clubhouse and a pool, etc., rather than your vanilla rectangular multifamily building. It just doesn't have the charm that rows of single family homes do.
Yeah, I'm invested in several build-to-rent projects around Texas. I think about 4 of them in total. And I also agree, I'm a macro trend investor, and I think this is the trend. When you look at the undersupply of homes, the increase in population, even despite a lowering birth rate of Americans, we still have an increasing population due to some policies that we're going to see an increase in population. So there's going to be just more demand on homes. And I don't foresee the government changing their strategy to allow for more builders to build more homes easier. So this is not a problem that's going to go away. And this, to me, like you said, people want to live in a home. They want to live in their own space, as evident from the pandemic. But that's just the American dream. And I think this is the new solution to the American dream. This is the compromise. You may not be able to have equity in it, but you will still be able to look at it as your own space. So it's coming.
Yeah, it's definitely an advantage. That's if you can actually have like multiple single family home and you have, like you said, like 100 of them close together, you can manage it almost like a multi-family because it's you get the economy of scale. The same thing, you have a maintenance guy that can walk around all of them, because that's one of the reasons why the multi-family, because of the economy of scale. But yes, I have seen portfolio of single family homes, and like you said, they give me a bunch of addresses. They're like, okay, you get 4 over there, 10 over there, 8 over there. And I'm just like, no. So it's much more difficult to manage. And yeah, I've not done any build to rent. I'm a true and true multifamily guy, but there's wisdom in looking deeper into it and also considering one of those.
Change that.
Hey, you know what? With my partner one of these days. Okay. And then where's your project?
When or
where?
Oh, it's in Lafayette, Louisiana.
Oh, Louisiana. Yes, I talked about it actually. Sorry. And then, okay, why that market, by the way?
Yeah, I had never heard of it either before I started working on these projects with my partners, but our general contractor partners, they grew up in Louisiana and they now live in Lafayette. So there are boots on the ground. It's a secondary, maybe even tertiary market, depending on who you ask. And so I think that gives us an unfair advantage where your big home builders, your institutional firms, private equity firms, they might overlook it for the Dallases of the world, the Phoenixes of the world, the Atlantas of the world. But because we have boots on the ground, like local market knowledge, that gives us unfair advantages of, hey, this is a great part of town to build in. This is not a great part of town. These are the employers that are coming in. It's like a needle in the haystack type of situation for us.
Okay. Anybody have any question? I know John, you got
John looks like he has a question.
Yes, I do. For build to rent, how do you guys deal with the loans, number one, and then the occupancy? Because I know that it has to take some time to have those structures occupied.
Yeah, the great thing with built to rent is that because they're individual structures, I'm not as well versed on this side. I mainly focus on the financials, but our general contractors, they could help better. But okay, I guess with the loans, we split our development into 3 phases. We do a land acquisition and entitlement phase. That's where we get our approvals and permits from the city, just like their stamp of approval that we can build a built-to-rent community. That's one loan. And then we move on to the horizontal infrastructure where we're putting in roads, utilities, sewer, curbs, things like that, water. We'll get another loan for that, usually. We'll put in the utilities and all that good stuff. And then once we get finished plat and we have approval to go vertical and build the units from the local municipalities, we'll go vertical and start building the units. And as far as occupancy, because these are typically individual structures, we've been building single family so far. We're looking at like duplexes and quadplexes, but single family, at least, if we're building 100 homes, as soon as one is built, you can get a certificate of occupancy, C of O on it, lease it up, and move on to the next one. I don't know if that's the case in multifamily. I'm not an expert there, but my understanding is lease up a lot sooner in built to rent because it's individual structures. You don't have to have.
What's your projection? How long do you think this unit would take to lease up?
For lease up right now, in our market, at least we're projecting 3 months after we build out the unit, that it would be leased up.
How many units can you build per month? Like how many are you delivering?
15.
Nice.
Yeah.
Have you run into a situation where the local government fails to give you like a permit? What do you guys do in that situation?
Yeah, so that's where our partners help out. They have experience with entitling land, getting those permits and approvals. They've worked on projects for D.R. Horton and some of these national home builders. So a lot of it comes down to politics to a certain extent, but also just knowing how to work with people at the city and figuring out what they want, what they don't want. Just like it's a negotiation with anyone, but it's a give and take. So maybe you want to build 10 extra homes on your site, and in exchange, you give them right of way or something, or you let them expand the road into your property a little. And then it's obviously building relationships with the people who are working at the city too, right? So that's a big thing of why we like Lafayette is our partners have been working there for a while. They know who to talk to. They have those relationships for years now.
Basically, you have to have the right connections.
Exactly.
I got a question. When you're doing this build, you're doing it in Lafayette, Louisiana, and I know you say you have people on the ground. How do you vet your contractors, especially the builder, the company that you're picking to do this? Or are you using multiple builders, or you pick one after you go through maybe interview 3 or 4 to pick which one is the right one, then you just move forward with them going forward? How do you do the due diligence on those builders?
On our general contractor or the subcontractors, or both?
The general contractor or both. I don't think you guys have control over, you guys might not have control over some of your subcontractors, right? Yeah.
We picked our general contractor just through one of my partners. He's in a network, Kingdom REI, and so he met our general contractor there. and just looked at his track record. He had been building homes from the ground up and also renovating them anytime hurricanes passed through Louisiana. He had been doing that for at least a decade, if not longer. And so he had experience building homes. It was just the capital and the scale of the syndication that needed to come into the picture to hit the scale that we're hitting now with build to rent. And beyond that, I think your typical questionnaire, this isn't something that I had to do, in all fairness. We went with, it was my partner who picked the general contractor, and there was a personal relationship there. But I think, as goes with anyone who you decide to do business with in this world of private investments, it's about track record, it's about getting references from them, like who else they've worked with in the past, asking them how their previous deals went, and vetting their character, seeing if you guys see yourselves working together long term on these opportunities. I think those are some of the basic questions that you could ask. Again, not something I have a lot of experience with, but I feel like those are the basic questions that could apply for not just a general contractor, but any partner you choose in this space.
What are some of the typical returns to your investors?
Yeah, these are a lot like any other development deal. That's what we're projecting, at least. Build to rent is still in the early stages. There haven't been that many exits as there are with multifamily developments. So when we pull comps, we have less data. We try to go off of what multifamily is trading at. 10 years from now, we'll know if build to rent has a lower cap rate than multifamily development or not. But for now, we're projecting that 20 to 25% IRR that investors typically like to see for development deals, taking that additional risk of no cash flow in the first 2-3 years in hopes of that higher upside. So
I think it tracks, yeah. Yeah, I always think development, it carries a little bit more risk, but then, yeah, you better be getting higher return in general, and also even a shorter stay in the deal rather than 5 years, be like 3 years. What's the usual exit for the project, or at least projected exit? Is it 3 years or 5 years?
Right now, at least, we're being conservative and just saying 5 years.
Okay.
Yeah.
We may even hold it after it's completed and cash flow a little bit before.
Yeah, and then refinance into something stable just in case something happens with the market. And in Louisiana, at least, local market conditions, it's raining every other weekend. So that stalls a lot of construction too. If it was in Phoenix or something where it's a desert, I'm sure we could build a lot quicker. But each market comes with its pros and cons. So
I've always also been, thought about this. What about selling some of it? Because since you get to build it as a single family, I was thinking maybe you actually make more money if you sell it as single family. I'm just thinking.
Yeah, I think that comes down to zoning regulations, and if they're all, again, something I'm still learning, but individually platted, I believe you can sell them off individually. But if it's zoned as a multifamily, then you can't sell it off individually. And then sometimes even if it is individually platted and you have the option to, then your local municipality might not want you to sell it off as one-off homes or portfolios. They might want you to sell it off to an institutional buyer, so that technically that's a business that's bringing in revenue into the community, and it gets to be more professionally managed if it's all managed by one landlord rather than leaving it up to the residents to manage. So it just creates a better curb appeal for the community in general.
Okay, good to know. Learn something there. Okay, any more questions? I know we are like 7:05 right now. Okay, thank you, Keshav, for coming. And how can people contact you if they want to continue this conversation?
Yeah, I would say the best way is to reach out to me over LinkedIn. Just if you search my name, I should come up. And I guess I can throw the link in here in the chat. And second, I would say is this, we put together some due diligence, like educational resources, things you should look out for when you're investing outside the stock market, and also why you should invest outside the stock market. So one of the questions was, what should I look for in a general contractor? So we included 100 questions that you should ask any operator or sponsor that you're partnering with, some of these questions that I mentioned, like track record, experience, what was the worst deal that you ever did? What did you learn from it? Things like that. And then there's a 5-minute read about why you should invest outside the stock market. If I haven't bored you by the end of it, then there's the ebook version, just goes in more into depth about additional data and stuff. So check our website out, and then just through my LinkedIn in there as well. Happy to connect and provide any education or resources.
Okay, thank you for coming, man. And then come back. Anything to add, George?
Oh, no, I want to just echo what Bio said. Thanks for coming on and sharing your experience. And I think everyone enjoyed the questions and the answers and just the learning. So thank you again.
Yeah, anytime.
Thank you.
Yeah, I appreciate you guys having me on. Hopefully we can work on some built to rent stuff or small business stuff in the future. And we'd love to have you guys on our podcast if you guys haven't scheduled already. And yeah, we'll keep the relationship going.
Absolutely.
Perfect.
I'm sure John will also want to.
Oh, yeah.
Okay, no problem. We'll get on. Take care,
Thank you.
guys. Thanks
All
for
right, guys.
coming.
Take care, everyone.
Thanks, everyone.
Yeah.